Hello, in this webinar series, we're going to cover more about technical indicators. So let's dive in. We're going to be utilizing the RSI indicator as one of the most used and common indicators as traders use, and as well a little bit about the MACDs. So starting with the definition of technical indicators, and they study a certain aspect that is associated with movement of products and prices. There are over 50 technical indicators, but we're going to be discussing the most popular ones. So here we're going to be talking about the measurement of RSI and how to read it. The RSI measures the ratio of upward and downward movements expressed as an indicator range from 0 to 100, and we most likely look at levels of 70 and 30. So an RSI of 70 or more indicates that the product has entered the overbought level, and this is kind of a risky sentiment and that we need to explore it a little bit. I will show you now on the chart. And while a reading of 30 or below indicates that the product has entered an oversold phase. Taking a look at the chart, here we can see an overbought phase, which is above 70, and the price can be ready for any shift in movement, or also over here, which is definitely indicated a reversal in trend from an uptrend to a downward trend. So over here, this is where we look at the over 70. For the below 30 also, we can see here that we are entering the oversold phase, which is kind of gives you an indication that selling might stop or is likely to stop, and that we need to take a look into when to buy and entry positions, and this is 30. Here we can see that as we were going on a downtrend, the question is, will it go more lower or is it going to reverse? And that's why we look at the RSI to give us this kind of indication. So here entered the bearish phase, which is below 30. And here it entered the overbought phase, which is above 70 and is likely to reverse the trend lower. Okay, so momentum indicators are useful because they tell us the right time to enter good trades, which ultimately guarantees a reasonable profit. Generally, it is recommended to use these indicators at a minimum, combining them with other technical indicators. So let's take a look at the rising and falling trends in the market. In a downward trend example, let's assume that the market is moving in a strong downtrend. In this case, we will notice that the RSI indicator will fall below the level 30. So as the indicator will fall below the level 30, the stochastic oscillator will reach the same levels. The RSI may rise again to exit the oversold zone, giving us a buy signal, but ultimately returning to the same zone to end your position with losses. So what we need to be careful here with is that despite being in this momentum, or at least going into this phase, we need to assess, are we going there and going to stay in the over sold levels, or are we going to reverse trend right away? Because sometimes it can just stick there for a big duration of time in the long run. So we need to assess, and we need to look at different kind of time frames, so we know that exactly. For example, here it's clearer that it's a sharp high, and then we're going to hit a reversal, but sometimes it's like a sideways movement that can reflect back up and then go back down, giving us losses. So that's why it's important to note where we're heading. In this downward example, I'm kind of giving you guys a heads up that even though we are below 30 and that we may rise again to exit the oversold level, thus giving us a buying signal, we can still stay under the level of 30 and still see a selling movement. Therefore, this is just tips and tricks for you to know. In an upward example, similarly, if the market is taking control or taking a strong upward trajectory in parallel with continuing to record new highs, you will notice that the RSI will rise to levels of 70 and then stay there for a long time. even in cases where it drops below 70 level and gives a signal to sell, it returns to the same peak zone again and ends in a short position at a loss. So if we go back above 70, let's say that we are here and above 70, and then you may assume here that the prices are going to start going down. However, since we just literally touched the area of 70, but then we went back up. So in this place basically. So this is a heads up that we also might stay in that position. In that case, we don't take the position right away. We wait for a confirmation so that in all cases where it drops below the 70 level and gives a signal to sell, we know that it is not going to the same peak zone again. So we need to wait and see if it's going to go into a sideways movement within this oversold level, or it's going actually to reverse the trend. This is a really important indication of trend reversals, and it would really help in your entry positions as well. So finally, we need to talk about the MACD's indicator, and it's considered a momentum and oscillator indicator. Exponential moving averages are used to calculate it with both convergence and divergence between those averages calculated. It's considered one of the most important indicators to measure direction and momentum as well. Let's see here. So what I mean by direction and momentum as well, that you can see here that there's two different kinds of bars, and there's also the lines of the moving averages. We can see here that we have an up direction and that the bars are heavily traded over here, which means that we have enough momentum and that there's enough momentum to go upwards, and we can obviously see the direction that is upwards and that we have high momentum using the bars. So this is the difference between the MACDs and the RSI, that we also have momentum and direction assist while trading. So the term MACDs is an acronym for convergence and divergence of moving averages. There are many different uses of the MACDs indicator, which gives a trader opportunity to use it in a variety of ways. And it can be used to measure momentum, monitor divergences, and also trend indicator, plus combining it with many other indicators. So having a look here, we can see that we have the moving averages as well going really high, which means we are in a swift momentum to go in an upward trend, and then we're going to see a sideways movement, and before going that we're seeing a slight downward trend and then slight sideways movement. So the bars here are going to tell you that we are seeing some low volume trading, for example in this instance over here. This is where it shows you that the momentum is kind of low and the volume is kind of low. We are still trading in a sideways movement, and we still haven't decided on the direction yet, and that therefore why it's mixed. Compared to, for example, over here where we have enough solid momentum and the moving average is also quite above the bars, meaning that we are definitely in a upward direction. In terms of a downward direction, the bars are also going to guarantee you us the amount of volume that we have in terms of reading this downward trend, and a confirmation that the bars are solid and they're high and that they're red, which gives us also an indication that we are trading in a downward trend. And then here we have a short upward bars, for example, which means that we might change the reversal. However, because the volume was super low, it also changed direction, but the moving average stayed the same, giving us a signal of low volume and potentially no reversal, no trading reversals to be seen or confirmed yet. Another method used to take advantage of the MACD signals, which is the most effective trading strategy, is momentum and divergence. It works according to the strategy, the MACDs, as an indicator of the RSI and can be used in conjunction with other indicators to obtain better results. Let's assume that the Euro-USD pair moves in a long-term uptrend and then recently forms a new top in a series of bullish highs. Looking at the MACD's indicator, we can judge the strength of the recent movement and determine if we are likely to see a reversal in the near term or it's going to give us a low volume bar and a low volume trend. Here are some cues for the entry points that can guide you to to enter the market. You can wait for candles to close above or below averages, waiting for breakouts or waiting for corrections. So you have to determine the entry point, obviously, before you start trading, and you also need to set up your right stop and loss. Sometimes it's possible that you place stop loss for long positions below a key previous low and for short position above a previous high, and also identify your target. I hope you guys enjoyed this small webinar about technical indicators, and stay tuned for the next one.